Assalamualaikum to our beloved lecturer, Puan Salsia binti Muhammad Ali. So my name is Muhammad Frisalman bin Muhammad Tarmizi. So today our group, which is group 4, will be present in regards to conceptual framework. So here are the members of the group 4. So the question for our group is students need to review the Malaysia conceptual framework on MESB website. So prepare a 40 minutes presentation and report the important findings from the Malaysia conceptual framework. Please also explain the similarities or differences between the Malaysia conceptual framework and the IASB framework. So the article that we take is from University Sumatera Utara, which is about normative theories of accounting, the case of conceptual framework project. So firstly, we move on to the introduction of conceptual framework. So basically, why we need a conceptual framework? So financial statements are prepared and presented for both internal and external users by many entities around the world. So these financial reports are based on estimate, judgment and models rather than exact depiction. Therefore, there is a need of conceptual framework in establishing this concept that underlies those estimate, judgment and models. So basically, what is a conceptual framework? So conceptual framework is defined as a structure or coherent system of interrelated objective or fundamental characteristics and concepts that lead to a formulation or development of high quality reporting standard and consistent reporting standard. So consistent reporting standard here refers to the MFRS, which is developed by MASB. So if it in Malaysia, but if it in international, it called IFRS, which is developed by IASB. So the conceptual framework also is to prescribe the nature, function and limits of financial reporting. So before we get more into detail, let's see the history on development of conceptual framework. So we move on to the history of conceptual framework. So the international framework is first developed in April 1989, which framework for preparation and presentation of financial statements were approved by the International Accounting Standard Committee Board. So in July 1989, the framework was published. So as time goes by, this framework has been used by the IASC until April 2001, when the framework was adopted by IASB that replaced the IASC board. In September 2010, IASB had issued the new version of framework, which is called Conceptual Framework for Financial Reporting 2010, that was approved by IASB. In March 2018, the Conceptual Framework for Financial Reporting 2018 was published.
Now, let us take a look at the objective of preparing financial reporting, which become a part of foundation of the conceptual framework. Firstly, managements and also accountants prepare financial reporting to enable users to access management useful information. The information should be useful for numbers of reasons, such as whether to provide credit to the customer, to lend the money to the borrower, or whether to invest in a business. Secondly, financial reporting assists reporting to users in making economic decisions, as it provides cash flow information to which company is subjected, including timing and uncertainty of the cash flows. This is very important in determining the liquidity and of the business, which later can be used to evaluate whether the organization can continue as going concern. Lastly, the objective of preparing financial reporting is to provide information to users that is useful for making and evaluating decisions about liability and also resource allocation. There should be emphasis on the changes in liability and resource, which can be used to predict future cash flows.
There are two characteristics which are relevant and faithful representation. Relevant means information is capable of making a difference in decisions, and the information will be considered as capable of making a difference if it has a predictive value, confirmatory value of both. The predictive value and confirmation value of financial information have an interrelationship because information that has a predictive value always has a confirmation value. Financial information has predictive value if it can be used as input by user to predict future outcome. So example based on the article that show the relevant characteristic is revenue information for the current year, which can be used as a basis for predicting revenue in the future year. Can also be compared with the revenue prediction for the current year made in the previous year. The result of comparison can help users to determine, correcting, and improving the process. Next, the faithful representations. Faithful representation refer to the financial statement that are produced accurately that show the condition of business. It should have a 3 characteristics to be recognized as a faithful representative, which are complete, neutral, and free from error. Complete means that it should provide all the necessary information needed by the user to understand, include all the details which are description and explanations to help them to understand the information. Neutral means the entity cannot be biased in selecting or representing the final statement. The last one, free from error, means that shouldn't be no errors or omission in description and explanation. So, based on the article, financial information provided devote most of the effort to collecting, processing, verifying, and disseminating financial information, but user ultimately bear all associated costs in the form of reduce of return. If the required information is not available, the user incurred additional costs to obtain the information from other sources or estimate from the existing information. Enhancing characteristics have 4, which are comparability, variability, timeliness, and understandable. Comparability enables users to identify and understand dissimilarities in and different amount items. The information more useful when the entity compares similar information with another entity for the other periods and dates. Comparability is driven with the consistency because a consistency refers to the same method for the same item. For example, selling and owing an investment or investing in the reporting entity or another. Comparability means provide assurance that the information faithfully represents what it purpose to be representing. Verification divided by 2, which are direct and indirect. Direct verification is information can be represented in the financial statement through direct confirmation and direct observation such as counting cash. Indirect verification is the process of verifying the input to model or other technique and recalculating outputs using the same methodology. For example, checking input in terms of quantities and costs. Timeliness means the information should be provided and available to decision maker in enough time to be capable of influence the decision. The older information is less useful and not relevant enough to be used to make a decision often. Understandability means that the information was on the basis of classifying, describing, presenting information clearly and concisely. The information usually prepared for users who have a reasonable knowledge of business and economic activity. Elements have 5: asset, liability, equity, revenue, and expenses. Asset is resources controlled by the entity as a result of the past event from which future economic benefits are expected to flow. It is an economic resources that has a potential to produce economic benefits. Next, liability is a present obligation of the entity arising from the past event settlement which are expected to result in the outflow of resourcing embedding economic benefits. The third one, equity. Equity is residual interest in the asset of the entity after deducting all its liability. Next, expenses. Expenses comprehensive losses as well as those expenses that arise in the course of the ordinary activity of the entity. The last one, revenue, is increases in economic benefit during the reporting period in the form of inflow of asset or decreases of liability that result in increases in equity other than those relating to contribute from equity participants.
Assalamualaikum. My name is Atira and I will present to you about the recognition and measurements of elements. Now I will explain to you about the recognition of elements. The recognition is the process of incorporating in the balance sheet or income statement an item that meets the definition of an element and satisfy the criteria of recognition. The first one criteria is the probability of the future economic benefit. It is probable that any future economic benefits related to the items will flow to or from the entity, which means it is referred to the degree of uncertainty that the future economic benefits related to the item will flow to or from the entity. The assessment of the degree of uncertainty is based on the evidence available when the financial statements are prepared. For example, when it is probable that a receivable owed to an entity will be paid, then it will recognize the receivable as an asset. The second one is the item that has a cost or value that can be measured reliably. It means that the use of the estimation in cost or value is an essential part of preparing the financial statement, and it does not undermine the reliability of cost itself. Now, let's take a look at the recognition of each element. For asset, it will be recognized when it is probable that the future economic benefits will flow to the entity and the asset has a cost or value that can be measured reliably. An asset is not recognized in the balance sheet when the expenditure has been incurred for which it is considered improbable that the economic benefits will flow to the entity beyond the current accounting period. Instead, it will be recognized as expense in the income statement. The second one is the recognition of liabilities. Liabilities will be recognized in the balance sheet when it is probable that an outflow of resources embodying economic benefits will result from the settlement of a present obligation, and the amount at which the settlement will take place can be measured reliably. The liabilities is not recognized in the financial statement when the obligations under the contracts that are unperformed. For instance, liabilities for inventory order but not yet received. The third one is income. Income is recognized in the income statement when an increase in the future economic benefits related to an increase in an asset or a decrease of a liability has arisen that can be measured reliably. The fourth one is the expenses. Expenses should be recognized in the income statement when a decrease in the future economic benefits related to a decrease in an asset or an increase of a liability has arisen that can be measured reliably. Next, I will explain to you about the measurement of elements. Measurement is a process of determining the monetary amount at which the elements of the financial statement are to be recognized and carried in the balance sheet and income statement. There are 4 different measurement bases are employed to a different degree and in varying combination in the financial statement, which are historical cost, current cost, realizable or settlement value, and present value. First, historical cost. Assets are recorded at the amount of cash or cash equivalents paid or the fair value of the consideration given to acquire them at the time of acquisition. And liability are recorded at the amount of proceeds received in exchange for the obligation or in some consumptions. For instance, income taxes at the amount of cash or cash equivalents expected to be paid to satisfy the liabilities in the normal course of business. Second, current costs. Assets are carried at the amount of cash or cash equivalents that will have to be paid if the same or an equivalent asset that was acquired currently. And liabilities are carried at the undiscounted amount of cash or cash equivalents that will be required to settle the obligation currently. Next, realizable or settlement value. Assets are carried at the amount of cash or cash equivalents that could currently be obtained by selling the asset in an orderly disposal, while liabilities are carried at their settlement value, which is the undiscounted amount of cash or cash equivalents that are expected to be paid to satisfy the liabilities in the normal course of business. Lastly, present value. Assets are carried at the present discounted value of the future net cash inflow that the item is expected to generate in the normal course of business, while liabilities are carried at the present discounted value of the future net cash outflow that are expected to be required to settle the liabilities in the normal course of business. Next, we move to the next presenter.
The next element in conceptual framework covers the capital and capital maintenance. Capital on financial aspect defined as invested money or invested purchasing power, synonym with net asset and liability. On its physical aspect, capital is defined as operating capacity or capabilities of an entity based on unit output produced per day. For capital maintenance, according to IFRS, financial capital maintenance is defined as the profit that is earned once the amount exceeds the net asset by the end of the period of time selected. It is measured in nominal monetary units or in units of constant purchasing power for its financial aspect. On its physical aspect, profit is earned only if the physical productive capacity at the end of period exceed the physical productive capacity at the beginning of the period, which has excluded any distribution from owners during the period.
So back to me. So I will be explaining about the similarities and differences between Malaysia and international conceptual framework. So the first similarity is that as a basis for financial reporting. So the objective of having financial reporting is the same, which is to provide useful information about the reporting entity to the existing and potential investors, lenders and other creditors in making decisions. Other than that, to assist the preparers to develop consistent accounting policies when there is no standard applies to a particular event. So second similarities is type of financial statement to be prepared. So type of financial statement to be prepared is balance sheet and income statement. So for balance sheet, it includes assets, liabilities and equity, while income statement includes income and expense, which the definition of this element, which are asset, liabilities, equity, income and expense, are all the same with the international conceptual framework. So next is convergence rather than adopt, which means that MASB and IFRS or IASB continue to working together to develop a high quality compatible accounting standards over time. It is because it need to be localized and the frameworks need to be complied with local regulation and financial reporting. So this convergence with IFRS brings a lot of advantage to Malaysia company, which is used to provide better understanding to its existing and potential investors from all around the world. Furthermore, the qualitative characteristics of useful financial information applied under each framework are identical. It includes two fundamental qualitative characteristics, which are relevance and faithful representation, and four enhancing qualitative characteristics, which are comparability, verifiability, timeliness, and understandability. Last but not least, the underlying assumption for financial reporting under both Malaysia and international conceptual framework are similar. It comprise going concern and accrual accounting assumptions. Under going concern, the financial statement must be prepared on ongoing concern basis. The entity will continue to operate in the foreseeable future. Under accrual, it is a method that records revenue and expenses when are incurred rather than when the cash is exchanged. So for the differences between MASB and IASB conceptual framework is the type of board. So MASB is specifically for Malaysian board, while the IASB is internationally for international, which is all globals or all around the world.